Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Julie Hyman this morning. Let's get to the three things that you need to know today.
First up, U.S. stock futures, little change this morning. That's after the S&P 500 wiped out its losses for the year. Shares of big tech stocks leading the market gains as the AI trade gains traction on Wall Street.
Plus, Nvidia and SuperMicro look to be some of the big beneficiaries of the AI deals being made during President Trump's visit to the Middle East. Bank of America saying Nvidia has a multi-billion-dollar opportunity related to AI infrastructure projects with Saudi Arabia. Meanwhile, shares of SuperMicro surging after signing a $20 billion multi-year deal with Saudi Arabia-based data center company DataVault.
And more companies are warning on tariffs. Electronics maker Sony warning of a $700 million hit from levies. But the company did say it could raise prices as an option to deal with the hit. Meanwhile, American Eagle shares are sinking as that company pulls its guidance for the year, citing macroeconomic uncertainties. The U.S. stock rally is starting to lose some steam after the S&P 500 wipes out its losses for the year. Investors in wait-and-see mode during the 90-day tariff pause. But Wall Street is optimistic with recession calls beginning to fade. So what's needed to keep the rally going? Yahoo Finance's Josh Schaefer joins us now with more. What's on the shopping list? What do we need?
Yeah, Julie, I mean, it seems like you need perhaps a little bit more news in terms of trade deals, right? And then also strategists coming out and saying that perhaps just more confidence in the economic data story, because right now it seems like you have a market that is no longer pricing in a recession and perhaps pricing in economic resiliency. So if you see some stronger data or data continue to hold up, that would probably be a key part of this. But I think, guys, I want to zoom out a little bit here too and just sort of highlight, you guys just mentioned off the top, we erased our gain or our losses for the year for the S&P 500. That happened, so 15% drawdown year to date for the S&P 500. S&P 500 bounced back in less than 6 weeks, erasing those losses. That is the fastest climb back since 1982 for the major index. That gives you a little bit of perspective on just this massive, massive rally, really, that you have seen in the last couple of weeks. And now strategists sort of sitting back and saying, okay, we have a little bit of a market price for perhaps perfection here at this point based on all the uncertainties that are out there. So people starting to feel a little bit more uneasy, at least in the short term, as far as where markets head next.
How much does AI need to be a part of the continued rebound?
I think it definitely does, Brad, right? So overall, I mean, that's what's been driving the market over the last couple of days. You guys just hit on Nvidia shares being up this morning. And I think it's interesting, we've talked a lot about S&P 500 is back to positive on the year. NASDAQ is back to positive on the year. You know what's not positive on the year? The Mag 7 index. Mag 7 index still off about 4.5%. I was just looking on the year. Of course, that also includes Tesla, which has had a massive drawdown. But I think overall, you're starting to see some of these strategists that see higher targets. David Kostin over at Goldman Sachs highlighting that he thinks more investors are going to continue to pile in to big tech and AI-related names, given that's where your earnings growth is. You're looking at an environment now where you have the 10-year near 4.5%. You've seen investors come into tech names in that environment, and he was looking just simply at first quarter earnings season. We haven't heard from Nvidia yet, but if you use the other 6 names in the Mag 7, earnings growth of 30% year over year. Then look at the S&P 493, earnings growth of 9%. So you're still seeing a lot of strength in those big tech cohort. So it might make sense for people to continue to maybe go back into those names.
You know, one of the interesting things that we had heard from investors over and over again before the tariff thing is that they thought this would be a pro-growth presidency, right? And it was sort of predicated on tax relief as well as regulatory relief. Now, the regulatory stuff, I don't know what's going on there. It's sort of piecemeal depending on the industry. The tax bill, though, we're waiting on it. But at this point, it feels like it is more status quo than significant upside for the market. In other words, if it wasn't going to happen, then that would cause a big issue for stocks. But it happening, and happening kind of as expected, doesn't seem to be maybe a catalyst.
No, but you know what is interesting in terms of tax cuts? I thought, so we mentioned the recession call, right? And so Michael Feroli, JP Morgan, had a recession call, took his recession call off because of the tariff scale back. He said, well, if tariffs are taxes, and I was penciling in 24% tariffs, now I pencil in 14% tariffs, that's a $300 billion tax cut on the American consumer. So if you're positive on maybe more tariff cuts coming and the tariff rate actually coming lower, that's also perhaps a form of a tax cut. Now, it's a tax cut that the administration, or a tax that the administration had certainly put on without most people necessarily expecting it. But if you're just penciling in growth, a way to actually kind of bring taxes on the consumer down in some way would be bringing that tariff rate down as well. So I think that's kind of an interesting other lever that they have as the administration kind of keeps jockeying the market.
Is it that clear of an offset, though? If companies are saying, all right, well, if the tariff rate is higher and we're just going to pass that cost on to the consumer anyway, how much of a real cut is it for consumers who are still going to kind of bear the burden of that added cost?
Well, I mean, I think he's sort of playing it out as a math equation, right? So if you're going to increase tariffs at a certain rate and the company's just going to flat out pass that on, right? So if it's 145% tariff on this product I'm getting from China and I'm going to pass all of that on to you, and then you cut that down to 30%, it is just kind of taking it off, right? If the company still is only charging you 30% more, what if they come down to 15% or the 10%, right? Then it is just passed on to you at a lower level, I think is essentially the argument that's being made there. Now, again, that's all sort of in flux in general. The final thing I'll say about Trump, and he's sort of coming up a lot, obviously, in these more bullish calls we're hearing on the street, seems to be a lot of confidence now that they don't want the stock market to go down.
Right.
They're all the strategists that are releasing notes that are more bullish on the street right now are saying, this administration has proven in the last month, they act like they're not looking at the market. It feels like they're really looking at the market. Julie, you're looking at me like I'm not sure if you believe that point.
I don't know. In the depths of things, President Trump seemed unwilling to bend purely based on the market. He also talked about the Treasury market in particular getting the yips, as he put it. Right. So I don't know if that was more the issue. I mean, you have to factor in the polling numbers to all of it too. He was getting dismal marks on the economy. So it's hard to sort of tease out one thing. I guess it is, does the leopard change his spots? And he always did care a lot about the market.
Right.
So I don't know.
It did seem like there was a bit of an about face when we were scratching the territory of bear markets.
Yeah.
And that was really prompted kind of the, okay, well, you know what? We're going to ease some of the pressure and we'll just pass everything over to China for the interim period of time. Right. Bring everybody else's tariff rate down to 10%, institute the 90-day pause, and then from there, we'll just negotiate and see what comes forward. And then, of course, now there's the trade truce with China, at least for this.
I think it maybe provides your protection from more trade war escalation, right? Sure. Which is sort of the fear here that we would go back after this 90-day pause into this back and forth. Maybe it provides protection there.
Josh, thanks for joining us this morning. Appreciate it. Futures pointing slightly to the upside this morning with the post-U.S. and China trade truce rally potentially beginning to fade here, though we're still fractionally higher, just barely. Our next guest says the U.S. could be the biggest loser of the trade war. I want to bring in Jay Pulaski, who is the TPW Advisory founder. Jay, just want to get your read in on some of the different machinations between all of the entities that have to negotiate because the trade war has essentially been kicked off within the first quarter of the presidency for Trump 2.0. And now, if there is a true resolve that investors should bank on, that business and CEOs should see in any type of site right now?
Well, I think, Brad, the real issue is that the tariff cat is out of the bag. And even though we've had several climb downs by the Trump administration, in part due to the impact of tariffs on market psychology, to your earlier conversation, particularly in our view on the Treasury market, the Trump administration has stepped back, most visibly and recently with China, but the cat is out of the bag. And so even with the pullback in the numbers of tariffs on China, you're still talking about the highest tariffs in the United States since World War II or earlier, and that's going to have a negative effect. I mean, it's very clear, virtually every economist, very clear. Higher inflation, lower growth, and that's not constructive. And at the same time, you have these machinations, as you call them, which lead to an erosion of trust and confidence in the policymaking capacity of the U.S. government, which then impacts the dollar and impacts equities and risk assets, which are at their essence, a form of trust, trust in governance, trust in the administration, and that trust has been severely bruised.
Jay, it's Julie here. It's good to see you. So, we get what we tend to get at moments like this, where everybody goes from one side of the boat to the other side of the boat, right? Which is what we're seeing sort of in the U.S. equity market in reaction to these tariff headlines. So what you seem to be saying, and that pivot could be described as a sort of sell America to now back to buy America. But it doesn't sound like that you're back to all in to buy America. So how are you seeing this then? Do you think what we've seen is an overreaction or over-optimism? And do you think that people should still be cautious on U.S. assets?
Well, Julie, as you know, we like to let the market tell us rather than us tell the market. And yes, the U.S. has rebounded aggressively, which makes sense because the U.S., again, is most impacted by the tariffs. So you reduce tariffs, the U.S. does well. But look, here's the point. The non-U.S. equity markets are leading the global market for the first time in 15 years. And so you can see that because Europe is breaking out to new all-time highs. Other regions are breaking out to 52-week highs, including places like Latin America as an example. And the U.S. is still well below its 52-week highs, well below its all-time highs. So the leadership has been tested because the non-U.S. equity markets were leading pretty much all year from the get-go. We had the massive pullback in April, which was a really good test to see if that leadership would be sustained. And what we've seen coming out of April is, in fact, that non-U.S. equity leadership has been sustained. So we've had a change in leadership. And really the question at this point, is it cyclical or secular? In other words, is it going to fade in a couple of months if the U.S. recovers and Trump somehow decides to not be a chaos agent? Or is it secular, in which case Trump is in office for the next 3+ years. We then have a change of administration. Trump is, by his own definition and nature, a chaos agent. That's going to require a premium to deal with the uncertainty. The rest of the world does not have that chaos in its governance circles, right? If you look at Europe, Europe is integrating to respond to the pressure placed on it by the Trump administration, really starting to flex its muscles, both economically and geopolitically. Look at China. China is moving aggressively to shore up its relations within Southeast Asia, which is the fastest growing part of the world. So it's the way we think about things at TPW Advisory, right? Tripolar world, regional integration in Europe, Asia, and the Americas. The Americas are going backwards. The rest of the world is going forwards. And so when you forget about the next couple of months, when you think about the next couple of years, we think of the U.S. lagging, trying to constantly deal with its rushing its own wheels, so to speak, going nowhere, while Europe and Asia move forward. And that is the world of increased growth in those regions, increased corporate earnings, higher multiples, more interest in ownership, higher stock prices. And that is, in essence, what leads us to believe we are in a secular leadership change away from the United States to the rest of the world.
Jay, we're all kind of awaiting what the clarity and the details around any type of deals that would come forward on the negotiation front off of the tariff policies, what those deals would look like and what compelling investment opportunities would emerge thereafter. What would you be kind of looking at in terms of your own checklist for making sure that the portfolio strategy matches up to what we're actually seeing come through in the details of these deals?
Yeah, no, that's really the key question, right, Brad? If you're a global macro investor, as we are, I wrote a piece a couple weeks ago called Old Timers Wanted. That was the title. And basically it was because for 15 years, the U.S. has led. And so there's a whole generation of investors who have never invested or managed a portfolio when non-U.S. equity markets were leading. And so it really is a different universe. And so we're actually quite focused on the rest of the world, right? We wrote a piece again called Stoic Strategy, How to Invest in the Age of Trump. And the number one point was to pay no attention whatsoever to what the president or his cabinet says, because it can change from one day to the next. And that is actually, in our view, an investing superpower. because not paying attention to what the president says allows you to focus on what is happening in the rest of the world, namely the integration in defense spending and fiscal stimulus coming out of Germany in Europe. That's very supportive. ECB cutting rates, that's very supportive. They can cut rates because the euro is strong. So Europe has both fiscal and monetary policy working. China, same thing. Fiscal stimulus underway, capacity to cut interest rates. And here's another really important difference when you talk about where we're focused. Very focused on emerging markets, in part because EM can also cut rates in this environment because the dollar is weak. Usually the dollar is strong in moments of crisis, and emerging market central banks can't cut rates because they're worried about their currency collapsing. That is very different. So we like EM equity, China, Latin America, Eastern Europe. We're also very focused on commodities. That's the big laggard coming out of April. No recession globally means commodities should do well. Commodities priced in dollars. Dollar is cheap. That makes commodities cheap for much of the world. So we like energy, we like industrial metals, and we're very focused on renewables thematically. We think the renewable space is breaking out after several years of underperformance because people are realizing to fill the power gap between 2025 and 2030 to deal with the AI you were talking about earlier needs power. And the way you get power in the next 5 years is through renewables. And so that space is really interesting to us and looks to us like it's breaking out.
Good to see you, Jay. Thanks so much.
Always a pleasure.
We've got some breaking news on AMD crossing the wire. Advanced Micro Devices announcing a $6 billion share buyback authorization. Shares of the chip company jumping nearly 7% on the news that the board has approved that $6 billion share repurchase plan. It represents about 3.3% of the company's current market value, according to data from Bloomberg. The new authorization, in addition to the remaining balance from their last authorization of about $4 billion, what that means, the total current repurchase authorization about $10 billion. And this news comes amid this wave of AI deal-making that we've heard about taking place in the Gulf during President Trump's visit to the Middle East. Bank of America analysts out this morning saying that AMD and Nvidia have a multi-billion-dollar opportunity related to AI infrastructure projects with Saudi Arabia. We should also mention AMD shares, by the way, have not done great this year. They have been trading down. So this sort of vote of support, if you will, coming on the back of that. We're going to be tracking, of course, the chips and all the news out of Saudi Arabia all morning long. Much more ahead on Morning Brief.
Now time for some of today's trending tickers. We're watching Nvidia, SuperMicro Computer, Sony, and Aurora Innovation. First up, chip stocks climbing. Nvidia extending its rally after announcing a deal to sell chips to Saudi Arabia. SuperMicro Computer also higher after entering a partnership with DataVault, a data center operator based in Saudi Arabia. You're taking a look at shares of both of those tickers here. They are moving higher pre-market here. SuperMicro jumping, as Destiny's Child would say, by about 20% right now. And of course, this wave of deals still adding a question back onto the table of, will these chips actually stay in Saudi Arabia? Will they make their way into other countries? That was one of the larger risks that was of concern, especially given how the kind of chip flow internationally has been also deemed a national security threat as well. That aside, you think about some of the opportunities that Nvidia is looking for in other countries if there continues to be a roadblock for them to sell into the Asia-Pacific region, specifically in China, and where they could potentially see some of those dollars and commitments flow into their business as well. Saudi Arabia this week, of course, is the du jour for all of these businesses.
Yeah, security, schmicurity, I guess, is the theme coming out of all of these stocks in the Mideast, right? With all of this following of the money and following of the big deals. And we keep talking about this morning, the Bank of America commentary around this, calling this a multi-billion-dollar opportunity for these chip companies. And Bank of America talks about sovereign AI. That's sort of the buzzword name for these countries investing in their own sort of governmental AI and data center build out. And B of A says, quote, that sovereign AI nicely complements commercial cloud investments with a focus on training and inference of LLMs in local culture, language, and needs. Could be 10 to 15% or $50 billion plus annually in the longer term in terms of the AI infrastructure opportunity. And Jensen Huang, CEO of Nvidia, has talked a lot about sovereign AI in the past and working with these countries on this stuff.
Absolutely.
Yeah. Well, next, Sony warning of a $680 million hit to profits this year due to President Trump's tariffs. The company also announcing a $1.7 billion share buyback. It provided details on the partial spinoff of its financial unit here. So the company's forecast not necessarily pleasing investors here, but the company is pushing ahead with this buyback and also gave a forecast for how many PlayStation 5s it plans to sell, or it hopes to sell 15 million in the year ended March 2026, its fiscal year, but that is a decrease from the 18.5 million units that it sold in the last fiscal year.
Which is interesting. I mean, they're raising prices too in several key regions here in some of the international markets, Australia, New Zealand, Europe, and still citing a challenging economic environment here, including high inflation, fluctuating exchange rates as well here. So PS5 prices still on the rise there in those strategic markets here. Also, one of the other things that I kind of noted off here, looking at the 0.5% drop in the previous year versus the previous year in revenue in this most recent release for Sony here. And then looking at some of the other categories, we've talked about how difficult, or at least it's come to the president's attention, how difficult the media, and specifically in some of the motion picture and the box office production, how difficult that environment is right now. Within that larger division for Sony here, we're taking a look at some of the sales within pictures coming in at 1.493 in sales, at least, billion. And thinking about what that means more broadly here, I think all of them are in a massive kind of investment phase for some of those motion pictures, and it'll be interesting to see what Sony continues to say on that front as well.
Gotcha. Let's turn to another mover now. Novo Nordisk agreeing to a deal with U.S. biotech firm Septerna to develop oral pills to treat obesity. Yahoo Finance senior health reporter Anjali Kamlani joined us now with more. So how does this fit into the existing portfolio at Novo?
This actually is part of a series of deals that Novo seems to be interested in because pills are seen as the next frontier for the hot obesity market. So this $2.2 billion deal builds on another deal most recently in March that Novo announced that was $1.75 billion. So you can see that price range about similar there for those deals. Septerna specifically having 4 candidates that it's looking at, and those platforms looking to come to market early stage right now. So Septerna is sort of in charge of leading those through the early stage where they figure out what the dosing is, and then Novo would take over after that. That fits into what Novo Nordisk is looking at, which is its own pipeline, having some candidates, but questions about whether or not they can come to market quick enough. They do have an application in for a pill version of Wegovy that the FDA is set to look at and decide on by the end of the year. Meanwhile, we know this also lines up with competition with Lilly, which has its own pill that seems to be further along and potentially the first to market, that looking to be in the market by next year. So really the obesity market heating up in terms of the pill space, and this is why Novo is pursuing those deals.
And Anjali, separately wanted to ask you about another story that caught my eye this morning. Roche, a drug maker that has planned some investment in the U.S., talking about maybe some risks to that investment.
Yeah, this is based on that executive order that President Trump signed yesterday, looking at the most favored nations, or rather earlier this week, the most favored nations, which is focusing on reducing drug prices. Roche saying in a comment to Bloomberg that if the proposed executive order goes into effect, their ability to fund investments that were previously announced, and they are referring to a $50 billion investment in manufacturing, could be put in question. This is the first company to come out kind of against this, and we were kind of expecting this because the drug companies have made clear, Big Pharma has made clear that these huge announcements ranging up to $55 billion, that highest number from J&J, Eli Lilly also with about $50 billion in total, all of these announcements have been geared towards avoiding any other ongoing pressure, including this most favored nations clause, including potential additional tariffs. We've also heard from AstraZeneca in a statement to us saying that it would, this most favored nation clause would need robust stakeholder investment and inclusion. So really trying to see what the industry does in light of all this additional pressure.
Anj, thanks so much. Everyone, we've got much more on the markets action ahead. Stay tuned. You're watching Morning Brief. Welcome back. You're taking a live look at the opening bell ringers at the NYSE and at the NASDAQ. On the right side of your screen, you've got Hashdex ringing the opening bell in Midtown Manhattan, Times Square. Yeah, go ahead, press that button, get yourself some funfetti. There it is, trickling in from the sky. And Horseman ringing the opening bell at the NYSE. Let's take a look at the major averages out of the gate here this morning as we've got the Dow Jones Industrial Average here on screen. We've opened up higher fractionally as it may be. We're up by about 0.2%. Let's put this chart on a year-to-date view just so you can see how much room we still have left to erase some of the year-to-date losses. But again, you could see the speed with which we saw the declines and now the move, the rally back to the upside here. And so ultimately got a little bit of ground to make up to see if we can get back in positive territory in the year-to-date scale here. NASDAQ Composite, that still's got a little bit more work to do as well. But the S&P 500 here on the day opens higher and now, of course, off of yesterday's move is back higher year-to-date as well. We're up by about 0.2% to begin today's trading activity. Also want to take a look a little deeper under the hood here. We are mixed on the sector front, 11 S&P 500 sectors. We've got them loaded up here for you on the screen. Looks like about 6 gainers to 5 laggards as of right now. Energy is pulling up the caboose. That's down by about 0.8%. However, technology, that's up 0.6%. Digital, get down. Okay, take a look at the NASDAQ 100 for a little bit more of that technological lens as we're taking a look at the NASDAQ 100. You've got some hyper oscillation for Amazon out of the gate here this morning, touching both sides of the trade as of right now, flat just barely to the downside. But also taking a look at Nvidia, we were talking through some of the deal making that's taking place within the Middle East. Jensen Huang, CEO, making his own foray out there, doing some shaking of hands, making some deals. And Nvidia is up by about 2.4% early in today's trading action. AMD, buyback announcement here this morning. That, you're taking a look at a move higher of about 6% off of that news. And then just lastly here, we've got some solid green here, forest green, if you will, on PDD Holdings. That's up by about 2% on the day. We'll continue to track those moves, but for a deeper dive, let me toss things back on over to Julie.
Thank you, Brad. It's time now for today's strategy session. The temporary trade truce between the U.S. and China sparking optimism on Wall Street with the S&P 500 wiping out losses for the year. But is there enough certainty to revive the M&A market or even IPOs? Joining us now to discuss, Scott Sperling, THL Partners co-CEO. THL Partners, a middle market private equity firm that's managed or deployed roughly $50 billion of capital. It's good to see you, Scott. Thanks so much for joining us.
Thank you.
So we definitely have seen this optimism, or at least a lifting of the pessimism that was with the public-facing markets at the sort of depth of the tariff crisis here. Are we indeed going to start to see capital markets in the private markets opening back up, M&A starting to spark more IPOs happening, or is it too soon to say that?
I think you will start to see more movement in that direction. Certainly the monkey wrench of the tariff announcement a couple months ago really sent shockwaves as we saw through the system. You saw it in terms of the public market trading, but I think we were also seeing it in terms of most companies saying we need to take a step back. We can't commit to different kinds of investments, and in fact, we may even want to slow down OpEx spending until we figure out how all of this is going to work its way through. I think what we've seen in the last week or so, and particularly with the hopeful signs of the meeting on Sunday with China, that we're going to come back to a point where the tariffs are going to be used in the way the market had originally hoped, which is to drive an ability to open up some foreign markets to U.S. manufacturers in ways that may have had issues in the past. And those issues may not have directly been tariffs. They may have been other kinds of barriers. We saw in the outline of an agreement with the UK that they were going to open up the ability of U.S. Beef producers to sell beef into the UK in ways they had not been able to do before. The issue that I think we all have to keep in mind, though, the one that is giving the market a little bit more than a little bit of a concern right now is the deals are outlines of deals. And we know that there's a long way from the outline of a deal to actually getting something signed. And I think all of our hope is that during that period, even if we don't get a deal concluded within 90 days with China, we extend out the period at which we're going to hold the more massive tariff levels in abeyance. And so, that uncertainty is still there. I think as you look at what the administration is, one of its objectives, the president has made clear that they intend to keep a 10% minimal level tariff on everything. And one should assume that that there will be some kind of reciprocity there. So the fact is there still may be some adverse impact on the price, the cost of everything that is out there in the global supply chain.
Scott, what we were hearing from a lot of executives early on in the earnings season, it sounded like this tenor of CEOs and executives feeling kind of neutralized, not helpless, but really reverting to a worst case scenario type of playbook, guidances being pulled, or at least giving a range of guidances of 2 scenarios, even in some cases, the case of United in that instance. So all that considered, what would business executives, the CEOs that you might even speak to, be looking for in these details to reassume confidence back into their own operations and also signal that to investors?
I think the most important thing is actually the signaling that the path we're on is to get down to no more than about a 10% tariff across most relationships that we have with countries out there. I think what really sent shockwaves, has been discussed, was just the nature of the formulation, which I suspect came out of Peter Navarro's office, that had numbers that made no sense to almost anybody. And the thought that that was going to be a way of basically decimating bilateral trade with China and a number of other countries. So I think what we've seen with Bessent in the discussions with China and with Commerce's discussions with the UK, I do think it's providing a little better feeling about what the objectives of the administration are when it comes to tariffs. I think the other area, and I think this is actually quite an important and big thing for this country. We have been a global leader in life science and healthcare for quite a long time. It is a huge sector. It employs probably more people than even if we brought all the steel mills that you can imagine back to the U.S. And there's a lot of uncertainty in that sector right now, given some of the soundings out of Washington about NIH funding and the way that they're going to deal with some of the related issues like indirects. So I think that is another area that impacts a very large swath of our economy and will also have an impact on some of the largest employers in the country. I know in Massachusetts, Mass General Brigham, where I chair the board, is the largest employer in the Commonwealth. All of these players are under extraordinary financial pressure already. And you're starting to see many places have to make very tough decisions about their employee base and also some very tough decisions about the nature and the breadth of the services they can provide.
Scott, finally, I want to make a little bit of a turn to ask about the private equity business and a big trend that's been going on, which is sort of opening it up more to retail investors, even if it's through institutions. The news today, there was a report that Empower, which is a giant 401k company, is going to be partnering with some private equity institutions to offer that option to some of their clients. What do you think of this opening up? What are the risks, rewards, briefly?
Sure.
And are you guys in talks with any 401k providers?
So private equity, I think, is we've all seen the numbers, and over almost any time period that goes beyond a 3-year period, and for most 1-year periods, but certainly in 3, 5, 10, 20 years, private equity has been the most stable, high return provider of all the asset classes. So there's a natural inclination on the part of people to want to participate in private equity. the nature of private equity is there will be some ups and downs, and we as an industry have not had a 5-year period of negative returns, and we're the only asset class that has not had that. So again, there's more stability than it looks in aggregate, but there will be ups and downs. I think the issue for retail investors is just to recognize the long-term nature of this investment. It's not something that you can trade or go in and out of without some risk that you're exiting at the exact wrong time and you've missed some opportunities. It's one that I think most institutional investors who have been the bulk of the money that has come into private equity fully understand. So, they tend, almost regardless of the economic environment, they tend to continue to invest at about the same levels, and those levels have been inching up, and in fact, in some cases, taken huge leaps forward. I think for a retail investor, this is a really important opportunity to participate in an asset class with the kind of characteristics I just described. But again, there needs to be an understanding that this is not like being able to trade or look for the opportunity to get very fast liquidity.
Scott, good to see you this morning just after the opening bell. Thanks so much.
Thank you.
Let's get to Yahoo Finance's Jared Blickery for a look at what is moving. Hey, Jared.
Hey, Brad. I am looking at the major indices once again. Let me give you the 2-day view on the Wi-Fi Interactive, pulling it up behind me. Here is the Dow. It had a negative day yesterday thanks to United Health. In the green today for a whopping 63 points. Can also take a look at the NASDAQ Composite. This would be the 6th day of gains if that holds into the close. You can see it's up 2.13% this week. And then the S&P 500 also holding on to gains of just about 1% off of the highs of the fledgling week here. Just want to note that this recovery that we've had, and Brad, I like the way you were showing that how the S&P 500 has turned year-to-date positive now. This increase in price off of these lows near bear market was the quickest since 1982, 2009, and 2020. All of those led to huge bull market rallies, 82 throughout the entire 80s, 2009 throughout a lot of the teens, and then 2020, that was that pandemic comeback. Also want to note that we had a de Graaf breadth thrust yesterday. This is in addition to the Zweig breadth thrust about a few weeks ago. And if that just sounds like Greek to you, all that means is market internals, what's going on under the hood, is very, very bullish. And when you get both of those signs within about a month of each other going forward, just quite a lot of bullishness throughout history. So that speaks as to the current market environment. Here is what's leading today. We got tech and consumer discretionary, and then healthcare. Those are the three leaders here. Healthcare taking a bounce after yesterday's drubbing, and we'll take a look at that United Health stock in a second. But I want to move over to the NASDAQ 100, where we're looking at some of the Mag 7 stocks leading the way. So far, that is Nvidia. Nvidia was leading the day yesterday. It's up 3% today. Here's a 2-day look. Tesla also looking at gains of 6.5% over the last 2 days. So a nice start to the week there. But want to show you the Dow over 2 days. And what's standing out to me is United Health. Here's a year-to-date chart. And guess what? United Health has been cut in half over the last month. And that was one of the highest ranking components of the Dow index because it is price weighted. It was in the 600s. Now it's in the 300s. And so that is quite a change for the Dow. Let's get over to the futures market because I want to take a look at gold, which is having a little bit of a setback. This is going to be a 1-day view, and here we see gold underwater by about 1.5%. Now this chart here is year to date, and it's up 20%, so the bull market's still intact for gold. But what I want to point out is this technical pattern. That is an M top, and gold has now breached that top. It could be a little bit of a fake out. If it is, we want to see it quickly recover and head northwards. Otherwise, we might retest that level and head downwards. But it just seems like gold is at an inflection point right now. I'm going to close on crypto, and for that we have Bitcoin. I'm going to be doing a deep dive in about 30 minutes or so. Here is Bitcoin year to date. And you can see we are pushing up against the highs that we saw, the record highs earlier in January, but we've kind of stalled out under 105,000. What's next for Bitcoin? Well, we'll be discussing that shortly, and I'll send it back to you, Brad.
Jared, thanks so much. Teeing up the rest of today's trading activity. Appreciate it. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Checking on shares of Oklo today, soaring 19% after reporting first quarter results. The nuclear technology company, not yet profitable, but it does expect to report for its first revenues in early to mid 2026. The company also announced that it finished drilling to gather information about the proposed location of its first nuclear plant, calling it a pivotal step. Joining us now is Vikram Bagri, Citi Alternative and Renewable Energy analyst. So, Vikram, Oklo, a maker, or I guess it will be a maker, of small modular reactors, which is sort of a newer style of nuclear reactors. None of them exist in the U.S. yet. So, I'm always curious how people are thinking about an investment like this, which is still relatively early stage.
Sure. I think Oklo has a differentiated strategy and a differentiated technology, which has evidence or proof of concept in form of reactors who have operated for a very long time, one FFTF reactor and one experimental breeder reactor at Ohio National Laboratory. So they don't need a demonstration of the technology. They have enough capital on the balance sheet, $260 million, to execute their strategy, get to the installation of first reactor. So they are owners of their own destiny in a way. Their differentiated strategy also consists of they don't depend on other companies to adopt the technology and spend the capital and build the reactor. Oklo will build the reactor on their own and will sell the electricity through long-term PPAs, which they have a strong pipeline of. So all they need to execute on this strategy at this point is approval from the NRC to proceed with their plans. And until they get the approval, or they are going through the process of getting the approval from the regulators to build these reactors, they can actually complete 70 to 80% of the construction of the reactor, beforehand, during the process of this approval. The way to look at it, I would say, is that there is no dearth of demand for these reactors, given the, sort of the energy needs in the United States driven by data center and AI. Cities forecasting data center AI and IT needs will grow by 110 gigawatts by the end of 2030. You have limited supply or limited capacity that gas turbines can add. Gas turbine capacity is sold out through the end of the decade. You have solar and wind somewhat restricted by how quickly you can add that capacity to the grid or grid constraints. And nuclear seems to be the way. It is also one of the only, I would say, renewable, subsector that has very strong support on both sides of the aisle, Republican and Democrat. Which I sort of joke about that. Republicans and Democrats, if there is only one thing in the world they agree on, is nuclear. Even if you sort of ask the color of the sky, they probably might not agree. One will say blue, one will say red. So it's a very, very strong support. Proven technology, enough capital on the balance sheet, and owners of their own destinies, what differentiates them. Finally, the way we look at it, I'll make a 30-second point, is every reactor they install, we calculate the value of their 50 megawatt reactor to be about $1.50 per share to $2 per share, about $1.75 per share of NPV of every reactor that they install going forward.
All right, we're going to be watching this one closely here. Between late 2027 and early 2028 is when they're targeting commercial deployment of that Aurora powerhouse. So we got a lot of time between now and then. Vikram, thanks so much for laying out the case. Appreciate it.
Sure.
All your markets action ahead. Stay tuned. You're watching Morning Brief. Wilbur Ross is weighing in on the current tariff regime, and he's got some advice for investors. The former Commerce Secretary, who handled tariff talks during the first Trump administration, said investors getting bullish on the thawing U.S.-China trade war need to pay attention to some big hurdles. Joining us now is Yahoo Finance executive editor Brian Sazi, who interviewed Ross on his podcast, Opening Bid here. So, Sazi, just take us into some of what the tenor was from Wilbur Ross.
Yeah, well, I want to ask the former Commerce Secretary, look, we've seen a lot of optimism on the day that I did this interview. This came after the big rally on Monday. Tech stocks, where we tape the podcast at the NASDAQ in Times Square. Of course, tech stock had a great rally after this China news. But I put this question to him. Are investors too optimistic on what might happen next on the U.S.-China trade front. Here's what Ross told me.
There are a couple of big issues that haven't been addressed. One is market access. The tariffs are one thing, but market access is another very big deal. Intellectual property being respected, big deal. And maybe most of all, enforcement. Remember, we made a deal with China, the so-called phase one, but they never implemented it. And then when the Biden administration came in, they didn't seem to have much interest in it anyway. So we really need an enforcement mechanism.
And I have more from this interview now in Yahoo Finance in a deeper story. But I like that Ross set up some of the clear challenges that will have to be figured out somehow, if they can even be figured out over the next, 87, 88 days. He ultimately told me that we may never see the end of the China trade war, that there will be some components likely sticking around for some time, which makes sense given how deep the issues are.
I mean, and Wilbur Ross, I mean, he was the Commerce Secretary, but like that's not really what yes, sure, he was the Commerce Secretary, but in a career like Wilbur Ross's, that was sort of the cherry on top or the thing at the end. I mean, the guy was chair of a number of different companies. He was in the steel business. He was a well-known banker.
Vulture investor.
Right, exactly.
That's how we got to know him.
Right, so he has a lot of deep experience in these issues, especially with the steel industry. So did he talk about
where I've relied on Ross? This is the fourth time he's been on the Opening Bid podcast, and each time, first and foremost, he still talks to the president. He knows President Trump, I believe, over 40 years. So it is very clear on the things that he says and how he says it. He still has the president's ear. I would say they do talk quite frequently, and a lot of calls that he's made on this podcast is proven correctly. Before this time, he told me Trump was dead serious, quote, dead serious about tariffs. And a couple weeks later, he hit China with these 145% tariffs. So when he says there's clear challenges that remain in place, and from an investor standpoint, it would make me concerned if I am too optimistic that things get absolutely settled, done and dusted, and we go back to some form of amazing, perfect world.
Does he agree with what I believe Scott Besson has called the strategic chaos that's been inserted?
No, and to that end, he pushed back on the notion that we are in a recession, or we might near a recession. Of course, I don't expect Wilbur Ross, a former member of the Trump administration, to say, yeah, we're going to get a mild recession,
right.
But still, I think he was a little bit more optimistic on the economy than some would think.
Interesting. All right, thanks, Saz. Well, that does it for the morning brief. Join me for the next hour for more analysis on catalysts.